With cooler-than-expected jobs report fueling speculation that the Federal Reserve is done hiking interest rates and economic activity expanding at a solid pace in the third quarter, the stock market rallied, closing its best week of the year. Given this backdrop, investing in top-performing large-cap ETFs Monarch Blue Chips Core ETF, MBCC, Get Rating, Vanguard S&P 500 ETF, VIO, Get Rating, and Goldman Sachs Hedge Industry VIP ETF, GVIP, Get Rating, could be wise for instant diversification and substantial gains. Wall Street closed its best week of the year after Friday's jobs report came in cooler than expected, sending the 10-year Treasury yield lower. The major average indexes registered sizable weekly gains as investors grew hopeful that the Fed's rate-hiking campaign is over. The S&P 500 index jumped 5.85%, and the tech-heavy Nasdaq Composite gained 6.61%, marking the best week for both indexes since November 2022. The Dow Jones climbed by 5.07% in its best week since October 2022. The Labor Department reported that the U.S. economy in October added 150,000 jobs, against the Dow Jones consensus forecast for the 170,000 payrolls increase, and lower than September's 297,000 jobs added. The unemployment rate grew to 3.9%, above expectations that it would hold steady at 3.8%. Also, average hourly earnings missed estimates on a monthly basis, increasing 0.2% last month, lower than the expected 0.3% rise. From an equity market perspective, this reading takes some of the pressure off inflation and interest rate concerns, while still reflecting a robust labor market that is adding jobs faster than the neutral rate of approximately 100K, said Michelle Kluver, portfolio strategist at Global X. After Friday's jobs data, markets reduced the probability of an interest rate hike in December to under 10%, according to the CME FedWatch tool. 2024 Stock Market Outlook. The Federal Open Market Committee, FOMC, kept the key federal funds rate steady at its 5.25% to 5.5% range in its latest meeting on November 1. This marked the second consecutive meeting where the central bank has chosen to hold interest rates. Also, the Fed said the economy rose at a strong pace in the third quarter. The Commerce Department reported that gross domestic product, GDP, increased at a 4.9% annual pace in the third quarter of 2023, above the 4.7% estimate. The U.S. economy grew faster than expected, buoyed by solid consumer spending despite higher interest rates, inflationary pressures, and other domestic and global headwinds. Given an optimistic market backdrop, investing in large-cap blend ETFs seems prudent. Most of these ETFs tend to invest in U.S. industries, with market caps of above $10 billion, and depending on their broad exposure, the portfolio's return is like that of the S&P 500 index. These ETFs are ideal for conservative investors who only want exposure to the biggest U.S. companies. Market observation and comments. The recent market performance, driven by the milder-than-expected jobs report, has left investors with mixed feelings. On one hand, the decline in the 10-year Treasury yield suggests that concerns about aggressive interest rate hikes have somewhat abated, providing relief to equity markets. On the other hand, the less-than-stellar job additions and the rise in the unemployment rate indicate that the labor market may not be as robust as previously thought. The substantial gains seen in the S&P 500 and Nasdaq Composite during this week, their best since November 2022, illustrate how sensitive markets are to economic data and the Federal Reserve's policy decisions. As Michelle Kluver, a portfolio strategist at Global X, pointed out, the employment report eases concerns about inflation and interest rates while maintaining a strong labor market that is still creating jobs at an above-neutral rate. However, it's worth noting that markets are now pricing in a very low probability of a rate hike in December, according to the CME FedWatch tool. This suggests that investors are still cautious about the possibility of the Federal Reserve adjusting its policy stance, given the economic landscape. The third-quarter GDP growth exceeding expectations is undoubtedly a positive sign, demonstrating the resilience of the U.S. economy in the face of various challenges, including inflation and global headwinds. It's a testament to the strength of consumer spending, which has continued to drive economic growth. In this market environment, investors are increasingly seeking opportunities for diversification, and large-cap blend ETFs are emerging as a prudent choice. These funds offer exposure to the stalwarts of the U.S. corporate landscape, providing a balance between stability and growth potential. Now, let's delve into a more detailed analysis of the three large-cap ETFs to understand their specific characteristics and potential benefits. ETF number 3, Vanguard S&P 500 ETF, VOO. VOO's focus on tracking the S&P 500 index makes it a reliable choice for investors seeking broad exposure to the largest U.S. companies. The S&P 500, often referred to as a benchmark of blue-chip stocks, includes some of the most well-established and profitable companies in the nation. With $323 billion in assets under management, VOO is a behemoth in the ETF space. One of the strengths of VOO is its impressive diversification, with 1,000 holdings in its portfolio. While it's designed to mimic the S&P 500, the top 15 holdings account for 47.85% of its assets under management. Apple Incorporated, Microsoft Corporation, Amazon.com, Inc., and Nvidia Corporation are among its top holdings, providing a good mix of technology and consumer-oriented companies. Moreover, VOO offers an attractive expense ratio of just 0.03%, significantly lower than the category average. This cost efficiency can be a key factor in long-term returns, as it minimizes expenses that eat into investors' gains. The consistent dividend payouts and growth in VOO are also worth noting. The annual dividend yield of 1.56% provides an additional source of income for investors, and the CAGR of 5.2% over the past 3 years and 6.1% over the past 5 years reflects the fund's ability to reward its shareholders. VOO's performance has been remarkable, with a 6.6% gain over the last 6 months and a 17.2% increase over the past year. It's also up by 14.1% year-to-date, indicating the ETF's resilience and strength. Market comment: VOO's broad exposure to the S&P 500 provides investors with a diversified and stable option to participate in the U.S. equity market. Its low expense ratio and consistent dividend growth make it an appealing choice for long-term investors. However, as with any investment, it's important to consider potential risks and market conditions that could affect its performance. ETF number 2, Monarch Blue Chips Core ETF, MBCC. MBCC takes a somewhat different approach by tracking the Kingsview Blue Chips Core Index. This index comprises well-established companies listed on the S&P 500 from various industries, emphasizing fundamentals like revenue growth, net income, and net income growth. With $48.40 million in assets under management, MBCC is a smaller player compared to VOO but offers its unique advantages. MBCC's top holdings include Microsoft Corporation, Eli Lilly and Company, Nike Incorporated Class B, and Starbucks Corporation. These holdings span different sectors, providing diversification within the fund's top assets. With 25 holdings, MBCC offers a more focused portfolio, allowing investors to potentially capture the growth of specific industry leaders. The expense ratio of 1.25% is relatively higher compared to VOO, but investors may find the portfolio composition and growth potential appealing, which could offset the higher expenses. MBCC has delivered a respectable 5.5% return over the past 6 months and an impressive 20.4% gain over the last year. This indicates the fund's ability to generate returns for investors despite its smaller size. Market comment: MBCC's strategy of emphasizing fundamentals and selecting companies from various sectors offers a unique approach to large-cap investing. Investors looking for more focused exposure to specific industry leaders may find MBCC an interesting option. However, the higher expense ratio should be considered in the overall investment decision. ETF number 1, Goldman Sachs Hedge Industry VIP ETF, GVIP. GVIP stands out among the three as it seeks to replicate the stock selections of top hedge fund managers. This approach involves screening publicly available data of fundamentally driven hedge fund managers to identify stocks that appear most frequently in their top 10 holdings. With $130.90 million in assets under management, GVIP offers a different angle on large-cap investing. The fund tracks the Goldman Sachs Hedge Fund VIP Index and includes 47 holdings. Vertiv Holdings Company, Class A, Vistra Corporation, and Palo Alto Networks Incorporated are among its notable holdings. This approach offers investors exposure to the insights of top hedge fund managers, potentially capitalizing on their expertise. GVIP's expense ratio of 0.45% is slightly higher than VOO but still competitive within the industry. It's worth noting that the fund experienced negative fund flows over the past month, which suggests a changing sentiment among investors. GVIP has outperformed with a 15.72% gain over the past 6 months and an impressive 27.4% increase over the last year. It's also up by 26.9% year-to-date, reflecting its potential appeal to investors. Market comment: GVIP's unique strategy of replicating the stock picks of hedge fund managers offers an intriguing way to approach large-cap investing. Investors seeking exposure to the insights of these professionals may find GVIP an appealing choice. However, the recent negative fund flows indicate a shift in market sentiment that should be carefully monitored. In conclusion, the current market environment, shaped by economic data and Federal Reserve policies, has investors seeking diversified and stable options to navigate the uncertainty. Large-cap ETFs like VOO, MBCC, and GVIP offer various approaches to meet these needs, and their distinct characteristics cater to different investor preferences. However, as with any investment, it's crucial for investors to conduct thorough research, consider their investment goals, and stay vigilant in monitoring market conditions.